For years, the crypto industry has argued that it wasn't asking for special treatment, just clear rules. Rules that would tell builders where the lines are, tell investors what's legal, and finally end the endless back and forth between regulators and innovators. After the passage of the Genius Act brought stablecoins into the regulatory mainstream, Washington was supposed to be ready for the next step. That next step is the Digital Asset Market Clarity Act, or simply the Clarity Act. This is the bill designed to define how non-stablecoin crypto assets are regulated in the United States, who oversees them, how they're classified, and whether America wants this industry built at home or exported overseas. Markets have been watching closely because this bill doesn't just affect crypto companies. It affects banks, capital markets, and the future shape of the financial system itself. But just as momentum appeared to be building, something unexpected happened. Instead of universal support from the crypto industry, some of its most powerful leaders slammed the brakes. What followed was a very public clash, not just between crypto and regulators, but between crypto and the traditional banking system. And at the center of it all is a fight over competition, control, and who gets to decide how money should work in America. To understand why this bill suddenly hit turbulence, you have to listen to the people who were directly involved in shaping it. Few figures sit closer to the center of crypto regulation than Brian Armstrong, co-founder and CEO of Coinbase, the largest U.S. crypto exchange and one of the most influential voices in Washington. When Armstrong recently spoke about what happened behind closed doors, he made it clear. This wasn't a last-minute tantrum. It was a reaction to what crypto leaders saw when the draft text finally landed.
Last year, we got the Genius Act passed. That was a great piece of legislation for crypto. And now what everyone's working on is called market structure, the non-stablecoin crypto assets. And there's been a ton of hard work. You know, the Senate has been amazing to work with. There's a lot of constituents coming in to offer their opinion, including the crypto industry. And of course, Coinbase has a point of view, although we don't represent the crypto industry. And we saw some draft text midnight on Monday night.
Right.
Our lawyers started looking at it on Tuesday. I was in D.C. on Wednesday. We started to notice some pretty serious issues in the draft text that we had a concern with, and there didn't appear to be a plan to actually get that fixed coming out of a Senate Banking Committee markup. And so we actually felt like we had an obligation to go out and defend our customers' rights and say, we have some issues here. We were careful not to comment on what the Senate should do in terms of markup or not, but they did decide to postpone it, and so now there's an opportunity for us to come back and chat with the bank CEOs and see what would create a win-win outcome here.
So top 3 issues right now for you that were problematic in that bill.
Yeah, so the number one is really around payment of rewards on stablecoins. I think Americans should be able to earn more money on their money. Banks should have to compete on a level playing field, and if the American people feel like the banks are not paying high enough interest rates and stablecoin rewards can offer them more, then maybe the banks should have to pay higher interest rates to compete, right? I don't think there should be any protectionism.
Do you think that was put in directly for the banks, that was lobbied by the banks and put in?
Yes.
And look, the banks argue effectively that the stablecoin market is going to force massive withdrawals that are going to come out of the banks.
Well, there is certainly a balance of where should this capital go. I mean, it can go to lending, which is important. It can also go to buying U.S. Treasuries, which is also important. And I think that it's essentially going to come down to where can people earn return for the appropriate amount of risk, right? If the Fed lowers interest rates, that would push more people to seeking higher returns from a lending product, right? If they raise interest rates, it's going to keep more money at the Fed. And that's frankly what a lot of banks are doing. They're holding trillions of dollars at the Fed also that's not being lent out. And so I think what we have to realize here is that crypto can provide solutions like rewards and stablecoins. It can also build lending products. Like DeFi lending is growing enormously. Banks can provide that also. And so we should have a level playing field where everyone can compete, clear rules, and everyone can win.
Should you have a level regulatory framework as well? Should you be regulated the very same way the banks are, if that's the plan?
Well, the banks are doing something very different, which is called fractional reserve lending. So they're actually lending out customer deposits without their permission, essentially, right, to earn the spread, and that's what the whole banking. That's why there's such heavy oversight from banking regulation.
What's different in what you're planning on doing with your customers' assets?
So under Genius, stablecoin issuers have to hold 100% reserve. It's not fractional reserve. 100% of the assets are in short-term U.S. Treasuries. It's very low risk. It's less risky than holding it in the bank.
The DeFi lending would be coming from what money?
That's customers opting into it, and they can say, all right, I actually want to earn more, so I'm going to put my money into this DeFi protocol, and I can get 6 or 7 or 10% return for some appropriate amount of risk. So it's customers opting into it as opposed to
the banks
doing it. I have been here meeting with bank CEOs. That's one of the main things I'm doing, is trying to figure out, okay, what would get them to a yes? I do believe there's a win-win outcome. I mean, by the way, Coinbase is actually providing crypto infrastructure services to 5 of the top 20 banks in the world. And so we're talking with the commercial sides of these banks, and they see it as an opportunity. Their lobbying arms and their trade groups are coming in and trying to ban their competition. And so, to me, you shouldn't be able to ban competition. Well, this is the same thing that money market funds do, right? It's when banks are holding their reserves overnight at the Fed, that's exactly what they're doing. So this already exists. It has nothing to do with crypto, actually. It's been there for a long time. And there's a lot of deposits that are very interest rate insensitive, right? So in my view, if this legislation goes through, there's going to continue to be that balance with banks and crypto companies. Where can customers earn the best rates and rewards? They're going to choose to put it in lending or in something that is linked to short-term treasuries. I mean, I was thrilled to see that. I think New York Stock Exchange announcing their interest in tokenized equities is just one more data point of the crypto is updating the financial system, and we want everyone to be able to do that and make our capital markets more efficient.
But does it take the moat away from everybody's business? If everybody can do the same thing, what happens in the end?
Customers win with competition. I mean, we shouldn't have policies being created in the United States that favor one set of companies over another. There should be clear rules of what's allowed, what's not, and then everyone competes. That's how the customer benefits.
Armstrong's core message is simple but explosive. Regulation should not be used to protect incumbents from competition. While he supports market structure clarity in principle, he argues that key sections of the draft went far beyond neutral oversight and into outright economic favoritism. One issue stands above the rest: stablecoin rewards or yield. Armstrong's argument is that if Americans can earn a higher return on stablecoins than on bank deposits, the solution isn't to ban the competition, it's for banks to compete. In his view, blocking yield isn't about financial stability, it's about preserving market share. This is where the conflict becomes less about crypto versus regulators and more about crypto versus legacy finance. To understand why markets care so much about this bill, zoom out. The Clarity Act isn't just a legal cleanup, it's a signal to entrepreneurs, institutional investors, and Wall Street firms about whether the U.S. is serious about hosting the next generation of financial infrastructure. That's exactly what Matt Hougan, CIO of Bitwise, highlighted in an earlier interview. He argued that clarity wouldn't just reduce risk, it would unlock growth across the entire crypto ecosystem.
The Clarity Act passing would be like a starter's gun for ETH and SOL to run into trillions of dollars of value. You know, what we have from a regulatory framework in the US right now is we got the Genius Act encoded, written in stone. Stablecoins are regulated, they can exist, they can be used for payments. The rest of the regulatory progress we've made over the last year is written in pencil because it's all regulatory decision making and it could be reversed in a new administration. So we feel really good about the state of regulation, but that could be reversed. And that prevents some high quality entrepreneurs, some high quality VC, some Wall Street firms from building on this because you're not building on the most sound, robust foundation. If the Clarity Act passes, we have the full regulatory spectrum to build the future of finance, to build a bankless world, to build real DeFi disrupting all financial action. And I think you're going to see just an incredible explosion of entrepreneurial activity, of Wall Street investment, of investor interest, of 1,000 different themes. So if we get it, we're going to see this massive explosion. I think we push really higher. If we don't get it, I think it'll be a real negative shock to the ecosystem. I think the market expects us to get it. There's some risks that won't happen. And I think it would be a psychological setback. I'm not saying that ETH and SOL can't get to all-time highs if we don't get the Clarity Act, but I do think it will be a big setback and it'll take some time for the industry to work through.
Hougan's warning is subtle, but important. Markets don't just react to outcomes, they react to expectations. And right now, expectations are high that the Clarity Act will pass in some form. If it does, crypto assets like Ethereum and Solana aren't just gaining regulatory clarity, they're gaining permission to scale. If it doesn't, the damage may not be immediate price collapse, but something worse: hesitation, capital waiting on the sidelines, builders choosing other jurisdictions, momentum quietly leaking away. That's why this debate matters so much, and why opposition from within the crypto industry itself raised eyebrows. An earlier tweet from Brian Armstrong provides some much-needed context for this strong opposition. The January 14th tweet lays out exactly why Coinbase could not support the bill as written. He warned that the draft text included, in his words, a de facto ban on tokenized equities, DeFi prohibitions, erosion of the CFTC's authority, and amendments that would kill rewards on stablecoins, allowing banks to ban their competition. Armstrong didn't mince words. He said this version of the bill would be materially worse than the status quo, and concluded with a line that stunned Washington. We'd rather have no bill than a bad bill. So why are banks fighting so hard on the yield issue? Bank of America CEO Brian Moynihan recently warned that interest-bearing stablecoins could pull up to $6 trillion out of the U.S. banking system. Fewer deposits mean less lending. Less lending means higher borrowing costs. From the bank's perspective, this is an existential threat, but from crypto's perspective, that argument reveals something uncomfortable. Banks have relied for decades on paying depositors as little as possible, while reinvesting that capital for their own gain. Stablecoins challenge that model by offering transparency, competition, and user choice. At its core, this fight is about who benefits from idle capital. Banks argue that allowing yield on stablecoins drains deposits and weakens credit creation. Crypto leaders argue that depositors deserve better and that innovation shouldn't be frozen to preserve outdated profit models. Globally, the stakes are even higher. If U.S. regulators ban yield while other countries allow it, capital doesn't disappear. It simply moves. Every industry adapts or falls behind. Crypto leaders argue that banking should be no different. Despite the stalemate, there are signs this story isn't over. While speaking with CNBC at Davos 2026, White House AI and crypto czar David Sachs acknowledged the tension and pushed for compromise.
Well, yeah, there's an issue right now, the so-called yield issue of whether stablecoins are going to be able to pay yield. Right. There's a difference of opinion between the crypto industry and the banking industry.
And where do you sit?
I'm in favor of reaching a solution and facilitating a compromise so that we can get a bill for market structure on the president's desk. We've seen this movie before, back in August when the stablecoin bill passed, the Genius Act. It died about 3 times before it finally passed and was signed into law. So there's a process here that has to be worked through.
What's a potential compromise look like? Because it looks like the banks don't want it to allow it to happen, and it looks like the crypto guys are adamant that it happened, that they'd be able to compete. How do you split the baby, I guess?
Well, I think the banks have to recognize that that yield is already a feature of the Genius Act that passed and was signed into law in August. So if the bill ends up dying, then there will be a form of rewards. And so I understand their point of view, but again, if there's no deal, then they're going to lose on this issue. So I think it's in their interest to work something out. At the same time, I would urge some of the crypto folks to be a little bit, to see the bigger picture. Yes, I understand that yield is philosophically important to them, but so is getting an overall market structure bill. So I think if everyone has an incentive to be reasonable here, I think, and if they do that, we'll get a bill.
But is it a bill comes and then there's a sort of longer fight that continues, do you think, afterwards?
No, I mean, it's already passed the House.
Right.
So
No. I mean, that you sort of get this compromise. The banks don't love it. Crypto doesn't love it. And then over time, after this bill if this gets signed, then there's sort of a continued fight to get even more.
Well, a good compromise is everyone leaves a little bit unhappy, right? But I think what's going to happen is that after market structure passes, the banks are going to get fully into the crypto industry. So we're not going to have a separate banking industry and crypto industry. It's going to be one digital assets industry. And I think
will they be regulated
their opinions are going to evolve over time. And I bet you, over time, the banks like the idea of paying yield because they're going to be in the stablecoin business.
Sachs' point is crucial. If the bill fails entirely, banks may end up worse off than if they compromise. Yield already exists under current law. Killing the Clarity Act doesn't eliminate competition. It just removes guardrails. And notably, Armstrong himself has hinted that talks are ongoing. In a recent update, he revealed that crypto leaders are actively working with banks to find solutions, especially ones that protect community banks, not just Wall Street giants. That suggests something important. Despite the rhetoric, both sides know a deal is inevitable. So this isn't a story about crypto rejecting regulation. It's a story about what kind of regulation gets written and who it's written for. And that brings us to the most important question of all. Not whether the Clarity Act passes or fails in a technical sense, but whether anyone truly wins from the version that may ultimately emerge. Whether the crypto market ends up with real clarity, real freedom to innovate, and real competitive parity, or whether it walks away with a bill that looks like progress on paper, but quietly reshapes the industry in ways that are far more restrictive than the chaos it was meant to replace. Because sometimes the most dangerous outcome isn't outright defeat, it's a compromise that costs more than people realize. That's the fear many in the crypto industry are now grappling with. Not that lawmakers will reject market structure outright, but that they will give the banks just enough of what they want to neutralize crypto's disruptive edge. Decades of lobbying power, regulatory capture, and institutional influence don't disappear overnight. And when those forces converge on a bill as consequential as this one, the risk isn't delay, it's dilution. A watered-down Clarity Act could lock in frameworks that favor custodial models, centralized intermediaries, surveillance-heavy compliance, and regulatory discretion that permanently tilts power back toward legacy institutions. Once that happens, it doesn't matter how fast innovation moves. The foundation itself has been compromised, and no one has expressed that fear more bluntly or more emotionally than Charles Hoskinson, founder of Cardano.
Why? Because we hate the other guys so much, we just have to tolerate this. We can tolerate neither. We're better than this. And I watched a slow train wreck as we barreled down towards clarity. You know what the current bill has in it? 137 amendments later, it hands the entire keys to the cryptocurrency kingdom to the Securities Exchange Commission. And you have to go beg and plead for them to make it not a security. All new projects are securities by default. How is that any better than what Scary Gary gave us under Biden? Did you vote for that? The hundreds of millions of dollars of donations and lobbying to pay for everything from the inauguration to the East Wing of the White House and all the stuff in between, families, crypto assets, all these things later, 1 year later. And what we got is Elizabeth Warren wrote the bill. That's leadership we can believe in. And you still got people like Brad saying, well, it's not perfect, but we just got to get something. You know, it's better than no clarity. Hand it to the same people who sued us. Hand it to the same people who put us out of business, who subpoenaed us, who put us in jail. That's better? That's what we fought for? That's what we voted for? And tell me, how do we change it? Like we changed the Securities Exchange Act of 1933. 93 years later, have we been able to change it? No. You pass it, you own it forever. Sorry, Brad. It's not better than chaos. Take the chaos and fight for what's right. Fight for integrity. I didn't sign up to hand the revolution to 15 banks, to live in a world where everything is a custodial wallet. Every transaction is KYC'd. Everything is mutable and reversible, can be frozen at a whim when that number comes stamped on my forehead. I signed up for freedom, goddammit. I signed up for a revolution. And the leaders in this industry, because they want that goddamn money. Oh, it's so tasty. They want the goddamn private jets and the lifestyle. They've handed the revolution off. They've taken their silver so they can be part of a new oligarchy, thinking that somehow the leaders of this oligarchy will treat them better than the serfs. It's not what I signed up for. It's not what you signed up for. It's not what this revolution was built on.
Hoskinson's anger isn't about personality clashes or political theatrics. It's about permanence. His central argument is that bad law outlives bad administrations. Once you codify a framework that defaults new crypto projects into securities classification, once you centralize discretionary power in a single regulator, once you normalize custodial control and reversible transactions, you don't simply fix it later. History shows that financial laws, once passed, harden over decades. From that perspective, chaos isn't the enemy. Complacency is. Hoskinson is warning that an industry born to challenge centralized financial power cannot afford to trade its principles for short-term certainty, especially when that certainty comes at the cost of decentralization, privacy, and permissionless innovation. Stepping back, the fault lines are now clear. On one side, banks are fighting to preserve deposit dominance, lending control, and a system that quietly extracts value from savers. On the other, crypto represents a parallel financial architecture, one that exposes inefficiencies, redistributes yield, and removes intermediaries where they're no longer needed. That's why the resistance is intensifying, not because crypto is failing, but because it's succeeding. This is exactly the phase longtime macro investors like Mark Yusko have warned about for years. First they ignore you, then they laugh at you, then they fight you. The digital asset industry is firmly in the then they fight you phase. The pushback is louder, more coordinated, and more aggressive precisely because the threat is now undeniable. But here's the part that often gets lost in the noise. Crypto is no longer a fringe experiment. It's a multi-trillion-dollar global industry with deep capital markets, institutional adoption, sovereign interest, and real-world utility. So stay informed, stay critical, and don't confuse compromise with victory. If you found this breakdown useful, hit the like button, subscribe for deeper analysis, and let me know in the comments where you stand. Is a flawed bill better than no bill? Or is this one of those moments where the industry has to draw a line? Thanks for watching.